Hey, what's going on, guys? This is Brandon, your trusted realtor, and I'm coming to you with another amazing episode. So, today I want to advance our conversation. We've talked before about different loan types, and if you're familiar with the home buying process, you know in order to begin the process, it starts with getting a pre approval, and that starts with working with a lender. A lender is going to identify the type of loan that you qualify for, and that is all primarily going to be stipulated on your credit and where you are. Now, you've heard these names probably before: FHA, conventional, USDA, and VA. These are all home loan product types or loan types. And it's going to be important for us to really dissect what these loan types mean in today's more progressing recessionary environment. So today I want to carve out a little bit of time and I want to spend some time breaking down what these programs mean and how they apply to you, on top of finalizing with a real clear understanding of what they mean to you in today's recessionary environment. All right, so let's dive in. So when we talk about loan types, those the ones that I mentioned before, FHA, we'll start there. It's the Federal Housing Administration, and that's going to be a government-backed loan. They essentially is going to dictate that the individual receiving this loan type is going to be eligible to put 3.5% down out of the entire loan amount. So we'll work in percentages. Whatever type of property you want to buy, whatever amount of property you want to buy, right now it's not really important. Let's think about it as being 100%. So 100% of that has to be paid in order for of the amount of the house in order for it to transfer to you. But at the moment, there's a requirement for you to have what is called skin in the game. So what the FHA loan product does is allows you to put down 3.5% of that 100%, so that way you can access the loan or access entering into the home with less money out of your pocket. That's what that vehicle does. Now, it's typically applicable to individuals who have between a 580 credit score and a 680 credit score. And so you'll say that gap, why does that exist? In part, that is the guidelines identified by FHA, but it's also important to remember that FHA does not make the loan. Rather, it's a mortgage lender that makes a loan. So the government would generally, which is what FHA is, the government would generally give out general guidelines, and the lender has the opportunity to refine those and to have more stricter guidelines or more stringent guidelines as it relates to you or how they're going to conduct business and offer money. So in many cases, you may not qualify for a loan or even down payment assistance with a 580 credit score. It's always a safe bet, a minimum of 640, especially if you're pairing an FHA loan with a down payment assistance loan product. Now, the cost of using an FHA loan is slightly higher because that comes with a monthly payment of private mortgage insurance. And that's something that attaches to the loan. It has to be something that's paid through the life of the loan. So more to talk about that, and that's actually a more advanced topic. The next thing or next loan type is a conventional loan. Many individuals find the conventional loan to be a great opportunity. In fact, a conventional loan typically applies or permits you to put 3% down of that total 100%, typically at the minimum amount. Now, you can always put more down if you choose to with a conventional loan, and the same is true with an FHA loan. Typically, individuals who are using a conventional loan product have higher credit scores, usually 700 and higher. You'll usually find that between 700 and 720, there's not much of a difference between what a lender is going to offer you because the interest rates is given or broken down in quarter points by every 20 or 30 or 40 points adjusted after above 700. So many individuals who may be on the cusp or the fence of using a conventional loan may be saying, hey, I only have a 700 credit score or 710. I really want to get to a 715 or 720 so that way I get a better interest rate. You honestly may not or probably will not receive a better interest rate for that difference. You really need to jump to like a 750, 775, almost 800 to really begin to see material differences. Those conventional loan products are usually saved for individuals that are best qualified because the better, again, as I've kind of already talked about, the better your credit is, the better the interest rate is that your lender will be able to offer you. As well as your lender may be able to throw in things like credits to you for buying a property, for being so well qualified, etc. The next loan type that we have is a VA home loan. Now, a VA home loan is for anyone, a veteran or service member that has served and has been anything but dishonorably discharged or that is actively serving. And what the VA home loan does is a 25% guarantee that's offered by the Veterans Administration, and it allows you to leverage your earned benefit in order to get into a house. Now, you do have to typically pay what is called a funding fee. Quite often, usually 99% of the time, most individuals elect to roll that funding fee into the cost of the loan so they can put that into the closing cost. The VA home loan product is an amazing tool if you are a veteran or a service member that is looking to access home ownership in your location. Now, I always tell people that this tool is extremely powerful, especially if you are going to PCS from every 3 to 7 years, probably 3 to 5 years. The average person stays in a home anywhere from 3 to 7 years. So, in fact, if you are quite honestly a savvy individual who is looking to not necessarily build a portfolio, but rather help yourself incrementally build generational wealth, you can easily, as you PCS, purchase a property, leverage the VA home loan product. It'll almost be zero down for you for the veteran. There are some closing costs, but compared to the typical conventional loan program or an FHA loan program, you're looking at sometimes either free or a few $1,000s. In fact, many individuals don't know that you can tack on programs. So you can use a program that we're going to talk about, like USDA, and use it to minimize your out-of-pocket costs. Anyways, the next loan product that we're going to talk about is USDA. I think that was a great segue into it. And USDA is the United States Department of Agriculture. This particular loan product is actually an amazing tool because they provide it's a 100% financing. So that means that if you are looking to get into a home, and the caveat here is that if you're looking to stay in a property that is in a rural part of America, and many people will say, well, I don't want to stay in a rural part of America. I don't want to stay in the country. But 96%, 97% of the United States is considered rural by the USDA standards. For example, if you are in a hyper-specific example here in the DC, Maryland, Virginia region, no part of DC will be considered eligible for a USDA home loan. But if you choose to live in Maryland, there's parts of Upper Marlboro, right? There are parts of Akakeek, there's St. Mary's County, there's Calvert County. All of these locations present opportunities for you to leverage a USDA home loan program, especially if you plan on living or want to live in that area. It's 100% financing, and if you also live in that area, because it is Maryland, you can leverage another program called the Maryland Mortgage Program, which is a down payment assistance instrument that'll assist you with some of the gap between down payment and closing costs, so that way it makes it more financially feasible for you to get into a house. I've honestly had individuals who have used the USDA home loan program, and I can't say this will be the same for everyone, but they've used the program and they've just come in, they've signed paperwork, and they've left. And not saying that they've gotten into a free home, but it's how you leverage the various programs and the assistance in order to create that type of success, right? So those are really the four different loan types, right, that we like to cover or that are generally used in the ecosystem. Now, when we begin to shift from loan types, we want to talk a lot about what does that mean for you. All of these loan types are going to be extremely powerful, especially as we move into a recessionary environment, as we move into a place where interest rates are going to continue to increase, where we have all type of inclination from the Federal Reserve that we are not going to see a balancing out of any type until 2024. What does that mean for you if you're an active home buyer and you're looking to be in this market? Now, they're going to be, remember, even though these are different types of loan programs, within them, and each lender offers you a different loan type. And they have their own types of programs that exist, like an ARM program. And so learning more about these different types of programs that can access lower interest rates may be a huge opportunity for you to begin to navigate the waters and access home ownership in the short term and access a much lower interest rate to get into a property. But you'll say, well, how do I then begin to use these loan types? How do I use an FHA loan in order to access a home? How do I use a conventional loan in order to access a property? And that all begins with having a discussion with your preferred lender. The lender's going to help you, believe it or not, to be able to put together your unique situation and your unique story. Each one of you is different, and no amount of YouTube University is going to help you figure out what it is that you are eligible for, what it is that you are entitled to, what it is you may need to work on in order to get to the place of being the best possible you or being the investor that you want. All of this starts with a relationship. Think about it this way. Not one time have you ever gone into a doctor's office and spoken to the doctor immediately. You call and you speak to the receptionist, and then maybe you go in and you check in with a completely different receptionist, and then you sit in the waiting room. And then you go in and then you're met by a nurse of some type. And then they do a lot of different work and assessments and they make notes for the doctor. And then you spend more time with other individuals tangential to the process than getting to the doctor. This same process may be true for you. It may be necessary for us to have a discussion to us be able to dissect where you are now so we can build a plan and inform you where you need to be. Now, when it comes to this recessionary environment, what is it that you're looking for? What is it that you're looking to do? And how is this impacting or going to impact you? As rates continue to increase, the biggest name in the game is being able to look at these different type of these loan types and asking your lender in the wake of increased home prices, that decreases my overall buying power, which is the amount of money I can afford, or the amount of house I can afford, or at least the amount of house I'm comfortable with for a monthly mortgage payment. That same $400,000 house that may have cost you $2,700 at the start of the pandemic is now easily $3,300 more a monthly mortgage payment. Each lender, unbeknownst to many lay individuals, have programs that have been nuanced and tailored to respond to these challenging mortgage environments. And having that conversation with that lender will allow you to peel back the layers. Most recently, I had a transaction where my client wanted to put nearly 50% down on the property. In addition to that, just really trying to figure out what was going to be a manageable monthly payment for her, even though interest rates were at 6.5%, 7%. In this case, we shopped around with various lenders and we were able to find a lender and a program where they were able to offer an adjustable rate mortgage instrument that for the next 10 years, that interest rate was solidified and stable. That means that you got a 10-year period before there's any type of adjustment in the interest rate and your monthly mortgage payment. That does two things. It allows you to leverage a conventional loan product in order to find an instrument or a tool, a type of loan tool that a lender has in order to help you figure out how to get into the home that you want while also getting you to the place where your monthly mortgage payment is where you want to be and where you want to maximize it. The name of the game is the information that you have, and in this recessionary environment, it's going to be more important than ever to align yourself with professionals that can walk you through the nuances of both a recession and how you leverage your home as an asset. We have entered into a place where there was a ton of different realtors in the ecosystem, and they are beginning to either retire out or they're finding themselves challenged with the reality that now you have to have a little bit more knowledge, you have to be a little bit savvy, and you have to understand the art and the science of real estate in order to be able to truly navigate clients to be successful. So hopefully this is giving you just a peel back the initial layers of your curiosity about different loan types and loan programs and begin to understand, like just like anything, when you begin to think about a loan program, or loan types, I want you to close your eyes and think about a hotel. You walk into a hotel and you realize they offer you a king size bed or a double room or a room with attached door. They offer you a suite. All of those things exist in that one hotel. And a mortgage lender is just like that. Depending on where you find yourself in your credit and your eligibility for a loan type, they have oftentimes, and multiple lenders are important to have in your pocket to have these discussions with, oftentimes have programs that have been tailored to match the needs of the population. It all begins with you having that conversation with someone you trust. So my name has been Brandon Scott. I'm your trusted real estate agent. I hope this has been valuable information to you. I look forward to being your source and your resource for all of your real estate needs. Take care, and I'll talk to you soon.